Today we're diving into a major shift in decentralized finance, real-world assets, RWAs, finding their way onto Aave. From tokenized treasuries to trade finance, the integration of RWAs into lending markets could turn Aave into the backbone of institutional DeFi. But before we dive in, did you know that only 40% of you listening are following us across our socials? We'd love your support. If you enjoy the show, please hit that follow button and collect our episodes on pods.media. Your engagement is what keeps the show going. Thank you for tuning in. Okay, let's unpack this deep dive. Our mission today is to break down this truly significant development. What exactly are real-world assets in the context of Aave? How does this integration work? Why it matters for you? And what challenges and opportunities lie ahead?
Yeah, and it's fascinating, isn't it, how Aave, one of the leading DeFi protocols, is really proactively putting itself right at the forefront. It's building this bridge between traditional finance, or TradFi as we call it, and the Web3 world. We should explore how this move could, well, fundamentally change how institutions even interact with DeFi, and what that really means for things like capital efficiency and trust, especially in this kind of hybrid financial system we're seeing.
Okay, so given Aave's pivotal role here, let's unpack the current landscape a bit. What exactly is happening right now that makes this the right time for this kind of integration? Our source material highlights that tokenization isn't just like a concept anymore. It's heating up big time.
Oh, definitely.
We're talking tangible assets, billions in U.S. Treasuries, private credit already live on-chain. So this isn't theoretical, it's active.
Exactly. It's a critical moment, a real inflection point. And Aave, being this major DeFi lending protocol, isn't just watching from the sidelines. They're actively exploring and actually implementing ways to integrate these RWAs as proper, robust collateral.
Right.
And that's the game changer, because it allows both the big institutions and the existing DeFi users to borrow against, well, the research calls them safe, yield-bearing assets.
Safe and yield-bearing.
Oh, yeah. So Aave is effectively carving out this role as a crucial gateway, creating a real pathway between that TradFi liquidity and Web3 innovation. And the timing feels right, because the tech is maturing, regulators are, well, at least talking more, and institutions want more capital-efficient, transparent options.
That makes perfect sense. So it's not just about sticking assets on a blockchain. It's about making them work in a completely new way. Now, understanding how this all works seems pretty crucial. You mentioned RWAs being issued as tokens, but backed by legal claims off-chain.
Yeah.
That sounds complex, kind of a hybrid thing. Could you maybe walk us through how that link between the on-chain token and the off-chain legal reality actually holds up? What's the trust layer?
That's a great question. And it's really the core innovation that makes this whole thing palatable, especially for the traditional finance folks. See, these tokens aren't just digital placeholders. They represent a real legally binding claim to an asset that exists off the chain. Think of it maybe like a securitized debt instrument, but you get the added perks of blockchain transparency, programmability. The trust really comes from those real-world legal agreements, often structured as SPVs, special purpose vehicles, or trusts.
SPVs.
Exactly. These legal entities hold the actual physical asset or the contract, and the token represents like a fractional, verifiable piece of ownership or a claim on that entity. It's that legal enforceability, the actual claims, that provides the necessary trust. It bridges the old legal system with the new blockchain transparency.
So a very deliberate mix, not purely crypto. And with that off-chain legal backing, you must have some traditional players involved. Our sources really emphasize the role of regulators and auditors. How do they fit into this technical process, especially when you also have oracles feeding in real-time price data for the collateral?
Precisely. Yeah, regulators and auditors are vital. They ensure compliance with existing financial rules and provide that sort of external check. Like an auditor might regularly confirm that the off-chain assets are really there and match what's shown on-chain.
Right, verification.
And at the same time, the oracles are the technical bridge for that live information, feeding in the crucial price data. Now, for RWAs, this isn't always as simple as pulling data from a crypto exchange, right?
Yeah, I can see it.
We're talking about assets that might not trade 24/7, or their pricing is fragmented, think certain private credit stuff. So getting accurate, continuous collateral values is a unique technical hurdle Aave and its partners are really working on. They often use sophisticated data aggregators, proof of reserve mechanisms, things like that.
That's a really key difference for RWAs. And Aave isn't just lumping everything together, are they? Their strategy involves setting up these isolated RWA markets or permission pools. That sounds like more than just organization. It feels like a critical design choice. What does that structure actually solve, particularly for institutions?
Absolutely. It's fundamental. These isolated markets are like dedicated lanes for specific types of real-world assets. The main benefit, risk management. Robust risk management. Institutions are, understandably, wary of the volatility in the wider DeFi space.
Sure.
So by creating these permission pools, Aave can tailor things like risk parameters, KYC/ML requirements, even the legal frameworks for specific assets or institutions.
Customization.
Exactly. It lets lenders own yield from RWAs, and borrowers can safely tap into that liquidity all within a controlled environment. It manages specific risks without exposing everyone to potential problems from other, maybe riskier, DeFi assets. It's about building confidence through controlled exposure.
That modular approach really does seem to tackle a core worry for TradFi. What about Aave's own stablecoin, GHO? How does depositing these RWAs fit in with GHO, and what does that do for capital efficiency?
Right, GHO. What's also quite neat and speaks directly to that capital efficiency point is the integration there. Our analysis shows that by depositing these RWAs, which remember often earn yield themselves, users can then mint GHO against them.
So you borrow against your yield-bearing asset.
Precisely. It instantly unlocks capital that was previously just sitting there. Imagine you've got a tokenized U.S. Treasury bond earning, say, 5%. Instead of just holding it, you deposit it into Aave, mint GHO, against it, and then you can use that GHO for other DeFi stuff, or even pay real-world bills, all while your original treasury keeps earning its yield.
That's like double dipping on your capital.
Pretty much. It's a clever way to make these otherwise static, even if yield-bearing, assets incredibly productive within DeFi.
That is a powerful mechanism. Okay, so boiling it down, what does this all mean for you, the listener? Why should this big shift grab your attention? Whether you're deep in DeFi already or maybe watching from the TradFi side, the material points to three key benefits. First, a big jump in capital efficiency. It's not just tokenizing, it's unlocking those dormant RWA yields, making them productive collateral inside DeFi.
Exactly. And the real insight there is how Aave's setup with those isolated pools in GHO lets institutions tap into this without getting fully exposed to the, sometimes wilder side of DeFi.
Right, the controlled environment again.
It's a calculated approach. It addresses their risk concerns, but still delivers that DeFi liquidity promise. Our findings suggest this could free up capital previously stuck in illiquid traditional markets, potentially boosting utilization rates massively for some assets, enabling new kinds of leverage or deployment.
That really does sound like a game changer. Which brings us to the second benefit, improved trust and transparency. You get sort of the best of both worlds, right? The regulated backing off-chain for security, plus the on-chain visibility and immutability of DeFi. For an institution, how does that hybrid model tackle the hurdles that stop them fully embracing DeFi before?
That's a crucial point. It directly addresses that whole Wild West skepticism TradFi often had about DeFi by combining the legal enforceability and regulatory oversight of off-chain structures with the transparent, auditable blockchain ledger. Aave builds a really robust trust framework. Institutions get the comfort of familiar legal recourse, but they also benefit from that real-time, tamper-proof record keeping. This level of verifiable transparency plus established legal protections dramatically lowers the perceived risk and compliance burden. It makes moving into DeFi not just possible, but actually quite attractive.
So it de-risks the transition.
Exactly. It's not asking for a complete leap of faith, more like a gradual, safer step.
And zooming out, how does that better trust and clarity feed into Aave becoming this essential institutional on-ramp? Is it just compliance, or is it something more fundamental about how finance evolves?
It's both, really. Compliance is kind of the entry ticket, but the fundamental pull is efficiency and innovation. Aave is providing the infrastructure, the secure, compliant pathways for these TradFi players to engage confidently with DeFi.
Confidently, that's key.
Yeah, they're not just testing the waters. Aave's building a ramp so they can drive in with serious capital. So whether you're an institution looking for new yield avenues with tokenization benefits or a DeFi native wanting more stable, traditional collateral, these benefits offer real value. It just expands a whole universe of possibilities. Not just for borrowing and lending, but for entirely new financial products built on this foundation.
Okay, let's shift gears slightly and talk about who's involved. Because this isn't just Aave working in a vacuum. It's a whole ecosystem of different players building this bridge. It really highlights how collaborative this evolution is. Where do we start?
Absolutely. Collaboration is key. First up, you've got the Aave, the Decentralized Autonomous Organization. They are absolutely crucial.
The governance aspect.
Right. They're the ones debating and voting on proposals for listing RWAs, setting the parameters for how they integrate, tweaking their risk framework. It's community-driven, which helps ensure it's robust and can adapt. They are the source, exactly. Without them, there's no bridge to build. These are often established financial institutions, maybe specialized fintechs, sometimes even government-backed entities. They're the ones turning the real-world legal claims into on-chain tokens. They manage the underlying assets. Hypercritical, yeah. For RWAs, oracles often do more than just price feeds. They might involve attesters who provide that off-chain verification, proving the assets exist and are held correctly. Exactly. This is where you see companies specializing in secured data feeds and real-world asset verification stepping in. They mitigate that garbage in, garbage out risk. Their skill in sourcing reliable, auditable data for non-crypto assets is really a cornerstone of this whole integration. But this is where DeFi's composability really shines. Imagine new structured products built using tokenized real estate as collateral, or yield farming strategies that use stable RWA-backed collateral for more predictable returns compared to purely crypto-native pools.
Interesting.
We could see totally new forms of credit, maybe new insurance products tailored for these hybrid assets. It's this collaborative nature that's vital. Success really depends on all these pieces: governance, issuers, data providers, builders working together smoothly. Yeah, this raises that important question. What are the roadblocks? Our research highlights several big ones. First, and arguably the biggest headache, is regulatory clarity, or rather, the lack of it. It's very fragmented, uncertain, varies hugely between countries. This creates a complex, costly compliance puzzle, especially for global institutions.
Yeah.
That ambiguity can really stifle innovation and put off big players. It absolutely is. That 247 DeFi nature clashes directly with traditional market schedules. If an RWA price only updates during certain windows, you risk stale prices. That could mean unfair liquidations for borrowers, or lenders being under-collateralized if the market moves sharply when the oracle isn't updating. Solving it requires really robust, often custom oracle solutions, maybe using things like time-weighted average prices, or even human-attested values in some niche cases. Fragmentation generally means less efficient markets. If capital is stuck in silos, it's harder for borrowers to find the best rates or deepest liquidity. Lenders might not get optimal yields either. It also increases the chance of price discrepancies between pools and makes the whole market less resilient. Aave and others are working on it, standardization, interoperability, but unifying such diverse assets is a big challenge. That's maybe the most fascinating challenge, both philosophically and technically. Exactly, respecting both worlds, not forcing one onto the other. Okay, connecting this to the bigger picture. Looking forward, we can probably anticipate a few key things. We'll likely see more Aave proposals for RWA-specific markets, probably starting with quite conservative risk settings. Yeah, build confidence, establish a track record, then gradually scale up as everyone gets more comfortable. Deliberate, secure growth. Absolutely. Backing GHO with yield-bearing RWAs gives it a really strong value proposition. It could potentially become one of the most robust and appealing decentralized stablecoins out there for institutions and individuals. That stability and yield could really boost its adoption across DeFi. That expansion is crucial for mainstream adoption. It signals we're moving beyond just crypto assets. We're reaching a point where a significant chunk of global financial assets could eventually be tokenized and interact with DeFi. These partnerships are the pathways for potentially trillions in value to flow in, transforming Aave into a really foundational piece of a new financial system. The ultimate aspiration, I think, is a super diverse, liquid, globally accessible market for almost any asset that holds value. Imagine fractional ownership of a building being instantly used as collateral for a loan. Or a tokenized basket of stocks used to mint stablecoins for business capital. It goes way beyond just lending. It could create a whole ecosystem of new investments, derivatives, financial services, all leveraging blockchain efficiency for assets that used to be illiquid or hard to access. It's about democratizing access to global capital. The pace, as we discussed, will depend a lot on navigating compliance and making sure those oracle systems are rock solid for all sorts of assets. But the direction feels undeniable. Real-world assets are coming on-chain. And Aave is incredibly well-positioned to make them liquid, trusted, and composable. It's fundamentally reshaping things.